Welcome to Thoughts on Investing. Today, we are diving deep into one of the most interesting and honestly most confusing stocks in the fintech space right now, SoFi Technologies. You see, the company is facing this massive paradox. Its business is absolutely crushing it, but the stock has been getting hammered. So in this explainer, we're going to figure out what is really going on.
All right, but before we jump in, just the usual quick reminder. This explainer is for educational purposes, okay? It is not financial advice. The markets can be wild, so please always make sure you do your own homework before making any investment decisions.
So let's get right to the heart of this thing, what I'm calling SoFi's big paradox.
Okay, get this. SoFi just came out with a phenomenal quarter. We're talking record revenue, incredible membership growth. I mean, by every measure, it was a home run. And what happened to the stock? It fell off a cliff. It makes no sense, right? So the big question we have to ask is, why? What is going on here?
Now, for anyone who's maybe a little new to SoFi, it is so important to understand that this is not just another online bank. Their whole mission is to be a one-stop fintech super app. The idea is you can manage your entire financial life, everything from banking and loans to investing, all in one single place. They even provide the tech that powers other financial companies. It's a huge ambition.
Okay, so to really unpack this, let's start with the good stuff. Let's look at the optimistic side of the coin, the bull case for SoFi. And listen, the arguments for being bullish are really strong. For the first time ever, SoFi just hit $1 billion in revenue in a single quarter. That's a 37% jump from last year. They also pulled in almost 1 million new members. But the real kicker? They actually achieved GAAP profitability. Now that's just a fancy way of saying they are officially making more money than they spend, which is something you almost never see from a high-growth fintech company. This is exactly why the optimists, like the analysts over at Mizuho, are sticking with a pretty high price target of $38.
But of course, it's not all clear skies. There are some very real reasons people are worried, and that brings us to the other side of the story, the bear case.
The number one concern for the bears all comes down to one word: valuation. The stock's forward PE ratio is over 70. That means the stock is priced for absolute perfection, leaving zero room for any mistakes. We're also seeing the stock sell off even after fantastic news, which is a big red flag that the market is still skeptical. And this caution is pretty widespread. The overall analyst consensus is just a hold, with some firms like Bank of America calling it an underperform with a much lower price target, down around $20.
So what we have here is a classic tug-of-war. We've got incredible growth on one side and a sky-high valuation on the other. Whenever I see a setup this conflicted, I like to just forget the noise and turn to the charts. So let's look at the technicals and see what story they're telling us.
You know, when the fundamental story is sending such mixed signals, the charts can sometimes be the best roadmap we have for what could happen next.
Now, if we look at the daily chart, you can see this amazing run the stock had, and then, bam, it slammed right into a huge wall of resistance between $25 and $28. And what's so important about that level? That's the price where the stock first launched its IPO. That's a massive psychological barrier where a lot of early investors might be looking to cash out, which makes a pullback from here totally normal and, frankly, expected.
But here is where things get really exciting. Let's zoom out and switch to the weekly chart to see the bigger picture. When we do that, a much larger and potentially very bullish pattern starts to take shape. It's a classic cup and handle. The big rounded bottom cup has been forming over the last couple of years. And this recent pullback? Well, that could be forming the handle. Now, this is a textbook long-term pattern that often suggests the next major move could be a big one, to the upside.
So if you're looking at this chart pattern, a potential strategy starts to emerge. The first area to watch is right around the $17 mark. That's a key support level. You could consider a small position there. But for the handle of the cup to really form properly, the price might need to drift a little lower, maybe down towards the $14 level. That area is a major zone of historical support, and it would be a prime spot to think about a larger position for a potential long-term rally.
So we've looked at the bulls, we've looked at the bears, and we've looked at the charts. Let's try to bring it all together now for a balanced verdict.
I saw one analysis that I think summed it up perfectly with this quote. SoFi is not a safe bank. It's not a slow and steady stock. It's a high-growth fintech company. And that means it comes with big risks if they can't execute, but it also comes with the potential for massive rewards if they pull off their super app vision. So what's the bottom line? Well, going forward, the real story for SoFi is going to come down to a few key things you need to watch. Can they keep executing and delivering consistent earnings?
Can they keep that incredible member growth going? And more importantly, can they sell those members more products? And finally, how are they going to handle the bigger picture, things like interest rates and the overall credit market? The answers to those questions are what will really decide SoFi's future.
So the big question for investors is this. Is SoFi's current pullback just the handle forming before a massive breakout? Or is that sky-high valuation just too big of a risk to take on right now? Let me know what you think in the comments. If you enjoyed this explainer, please don't forget to like and subscribe to the channel. Thanks for watching.